Hey everyone, I am Carissa Wright, broker associate at Beach City Brokers in Redondo Beach, and today we have a special guest. Yay, not me talking. This is not only my friend, but also an amazing loan officer lender, Katrina Barry, and Kat, as I call her, but you can call her Katrina, right?
Yeah, Kat or Katrina, but everyone calls me Kat.
Perfect. So Kat works with Movement Mortgage. So I invited her here today to answer some of the questions I received through Instagram recently. And obviously I get a lot of questions about loans and all of the details and things that go into it from my clients. So wanted to make a nice little video to answer them all here for you. So welcome, Kat.
Thank you.
Thanks for taking the time. So tell us a little bit about yourself and your company that you work for.
Okay, so my name is Kat or Katrina. I work for Movement Mortgage, and we are a mortgage bank, one of the fastest growing mortgage banks in all of USA.
Oh wow, I didn't know that.
Yeah.
Very cool. How long have you worked there or been in the loan industry for?
So I've worked at Movement for a year, and before that I was with another brokerage, and then before that I did loans in Sydney, Australia, which is where I'm originally from.
Yes, which I obviously know, but everyone always wants to know where the accent is from,
Yes.
So that makes sense. Now, obviously, I work with a ton of different lenders, but every brokerage, every lender has a different program or a reason why maybe a client should choose them. So what is it about Movement? What are the reasons that a buyer or borrower should use Movement Mortgage for their loans?
Okay, so Movement has a different process. We have what I like to call a reverse process. So typically when you use a normal lender, you will submit the file, goes to processing, you go to underwriting, whereas at Movement, as soon as the file is submitted, the first person that touches the file is the underwriter. So we have like a 6-hour goal where the underwriter tries to go in, underwrite the file, and then it's conditionally approved. So then we've got a target processing date of 7 days, which means the processor has 7 days to go and collect all the conditions and then submit it for final review.
Got it.
And then go into closing, and it's a completely different process, which is super competitive in today's market, like to be able to do things as quickly as we can.
So that's like how you guys really stand apart from your competition, is like you guys are just able to, from start to finish, be way quicker than other lenders for the most part.
For the most part, yes. And we also offer a completely fully underwritten upfront approval before you found the house. So we call it a TBD approval, but it's completely underwritten. So you've already got the conditions from your underwriter. You already know what your conditions are and whether it's doable or not.
Yeah.
And so a lot of people like to get their files underwritten, fully underwritten, before they start to go searching for a house. And it's really attractive to sellers, knowing that they've been fully underwritten.
Yep. And like 100%, I mean, especially in this market, in a seller's market, I am encouraging all of my clients who need to use a loan, which is most of us, right? So I'm encouraging all of them to have their loan fully underwritten first, because it gives us then the flexibility to remove not only our appraisal contingency, but also our loan contingency, making us more competitive with a cash offer. Because again, we've talked about this, there's 3 contingencies. If we can remove 2 up front, we're in the game.
And not only that, but you can also submit your offer with a shorter escrow period, because you've already gone through the process of underwriting, collecting all the docs, and now all that's left is gathering the conditions to submit to final. Yeah.
So obviously that's a great reason to use Movement. It's a reason that I use Movement and Kat. Now, I recently did a video talking about the differences in a mortgage broker versus using a bank and which types of clients I typically recommend to go with each lending institution. So are you guys a mortgage brokerage or are you guys a bank?
So we are actually a mortgage bank, but we also do broker out as well. So we are a one-stop shop. basically whatever we don't do in the house, we will broker it out to other investors.
Oh, okay. So you guys can do both. So you potentially could work with both clients, like a W-2 client, a 1099
Absolutely.
client. Like you see a variety of borrowers.
Yeah, absolutely. We do all the different loan programs. So and non-QM, which is a non-qualified mortgage, as well as conventional, FHA, VA, all of them.
Cool. Awesome. Actually, didn't know you guys did FHA and VA too.
Yeah. Everything, baby.
So I work with a ton of first-time home buyers, and maybe some of the things that we are talking about could be a little bit confusing. So I am curious if you can give like a brief rundown of what the process looks like from the time that someone's like, okay, I'm ready to buy a house, and they find you, to the ending, just kind of an overview of what that looks like.
Okay, so typically what happens when you think, okay, I'm ready to start looking for a house, I wanted to see how much I can borrow, like what can I qualify for? So you would speak to your lender. Your lender would essentially get you to fill out an application.
Okay.
Then you would provide them with all the supporting documents, like so that's your income documents, that's your assets, so your proof of funds for a down payment, plus any other documentation that we require.
Okay.
We then review the file, see how much you qualify for based on the information after pulling credit and seeing what your liabilities are like, and then I would basically discuss like what loan product or program I think that based on your situation you're like most suitable for. I would issue a pre-approval letter, and then you would take that pre-approval letter with you while you're shopping, and then once you're ready to make an offer on a house, you would submit that with your offer, and then in hopes that you would get into escrow.
Yeah, and then we go through the whole underwriting process that you're talking about if it hasn't been done, and to the processor. Okay. There was something that you said that I thought maybe someone wouldn't know necessarily. The liabilities. What are your liabilities?
So liabilities is basically anything that you see on your credit report. So it will be car lease, car payment, credit cards, student loans, other mortgages, like just personal loans, any type of
like installment loan or anything that you have, basically. For the most part,
exactly. But
to help calculate like your debt to income ratio.
Exactly.
Okay, got it. Now, the market that we live in, the South Bay, is obviously home prices are high, right? So if someone's a first-time home buyer, especially, I see that a lot of my clients have this issue, is not having 20% to put down. I mean, to buy $1 million house, which there aren't many of those left anymore in this area, you're putting $200,000 down. And unless you're selling your house and taking that equity, a lot of people don't have that kind of cash. So do you guys have loan programs where you don't have to have 20% down?
Oh yeah, absolutely. So if we're talking specifically about the South Bay, a lot of the home prices won't really fall in the conventional loan limit. They would be more likely a jumbo. So we have all different types of products where you can put as little as 3.5% down as a down payment.
Oh, okay.
Yeah.
And jumbo loans, just for someone who doesn't know, what's the difference between a conventional and a jumbo loan?
Jumbo loan is any loan, like in Los Angeles County, that's over $970,800.
So borrowing more than $900. So if you're buying a $1.2 million house, but the loan amount is $978.
Yeah, it has to be over that amount. And even if it's under, we would still be able to put down 3%.
And with the jumbo, does that, like, why is that different from a conventional? Are interest rates higher? Is there something different about a jumbo loan compared to a conventional?
So conventional is basically, it's underwritten. We were speaking about the underwriter before. It's underwritten based on the conventional guidelines. With jumbo, there is like so many different products, and every single product has its own set of guidelines.
Okay. So
generally, the better the rate, the more documents you have to provide, which means like 2 years of everything.
Got it.
Yeah.
Okay. Just more like red tape around it.
Exactly.
Got it.
Exactly.
Let's see here. Let me check my notes. Oh, I get this question all the time. Poor credit. So recently I had a client and they had great cash flow. They owned a business. They had great cash flow through their bank accounts. But, they had something happen personally a few years ago that had unfortunately affected their credit. And so they were like, we want to buy a house one day, but we're worried we can't do it because our credit isn't great. So what do you say or see when you have clients like that? Maybe that they do have the income, they do have the cash flow, but their credit isn't great. And where should someone ideally be credit-wise to really qualify?
So ideally, someone should, it really depends on what kind of loan you want to get as well. So like if it's a jumbo, you really want to be 700 or higher.
Okay.
If conventional, 640 at a minimum.
Okay.
And then FHA would be like 580.
Oh, okay.
So you could, even if you're below 580, you could still qualify for an FHA loan, but you would just have to put more of a down payment down.
Got it.
Yeah.
Got it. And on FHA, is there a cap for how much you can purchase or the loan amount on FHA?
Yeah, so actually in 2022, the loan limit for FHA on a single family residence is the same as conventional. So it's actually 970,800
for LA County.
Yeah.
Cool. I didn't know that. We already talked about, affordability, and that's something that you really deal with your borrowers in the very beginning by calculating their debt to income and all of that. And that helps to calculate how much you can qualify for.
Right.
And this is why I always tell my clients, we're not even going to look at houses until you've been qualified with a bank, because you might think, putting into your little calculator on Zillow or whatever that hey, I qualify for $2 million. But until you really sit with a lender, you can't actually know that for sure.
Right. Exactly.
What's the difference between a pre-qualification and a pre-approval? I get this question all the time. I see it oftentimes where people are like, I've got this, but they actually have that. So what's the difference? And do you guys do both, or do you just do one?
So we generally only do pre-approvals. So the difference between a pre-qualification and a pre-approval is that a pre-qualification is kind of like a loose, I've seen your pay stubs, you've told me how much money you've got for a down payment, I may or may not have run your credit, so it kind of looks like it's going to work. I've done the numbers quickly, and based on what you've told me, it sounds good. But a pre-approval is where I've verified your income, so I've got all the documents, and I've verified your proof of funds, so I've seen your bank statements, where is your down payment coming from, where are your reserves and your closing costs, and I've also run your credit.
Okay.
Yeah, and I've set you up on a loan program which I think you're suitable for.
Okay.
So it's just a lot more in detail.
Depth,
yeah,
and thorough. Yeah. So I always tell my clients, make sure that you have a pre-approval, not a pre-qualification. I know that for me, when I'm on the listing side and I'm reviewing offers for my clients, if I have a pre-qualification, in this market especially, if we're looking at multiple offers, if I've got 10 offers and you've got a pre-qualification but not a pre-approval, you're automatically out in my book. Right.
Yeah, a pre-approval is basically a more solid way of saying a lender has assessed your file and you're good to go. But to take it that one step further, to have a fully conditional underwritten approval is it's way better than a pre-approval as well, more competitive, and it's just more 100% that they've already been approved because they have by the underwriter.
So this kind of ties on to what I was going to ask next, which is about pulling credit. And I know a lot of times my clients, they don't want to check to see what they qualify for, what the different programs are with different lenders, because they're scared about having their credit checked multiple times. So are there options for people who are scared, or what do you have to say about that?
So basically, if you give me all your documents, but you say hold on the credit for whatever reason, because they've had multiple pulls and they're scared that it's going to affect their credit score.
Ding them again.
You could possibly give me a list of all your liabilities, and that way I can do a review, but it wouldn't be a true pre-approval.
Okay.
because I really am just taking your word for it. I don't know your actual FICO score. Yeah. So then that would fall into the category of being a prequal rather than a pre-approval.
Well, and I do know, and I'm sure you guys see this too, when clients have done a pre-approval already in another bank, but then they end up coming to you, because this happens. Sometimes I have clients who will cross-qualify, or they'll have two, kind of loans ready to go in case something happens to one. But according to CFPB, the Consumer Financial Protection Bureau, you technically are allowed to pull credit multiple times for the same loan type within 14 to 45 days.
Yeah.
And that is so that you can make sure that you're getting the best product for yourself. So as long as you are like ready to go, you're serious about buying a house, you can technically double check with multiple lenders within this time frame.
Yeah, it won't affect your rate as such, but those credit inquiries will still show up.
They'll show up. Okay, but it won't drop your score. It might just do it like a little bit.
But yeah, it's very common for people, especially as rates are going up. Everyone is shopping around a little bit for the best rate, and so it is very common to go and it's smart.
Yeah, it is smart. I agree. Speaking of rates going up, I've been, I've been seeing quite a few escrows canceling in the last couple of weeks.
So have I, yeah.
And it's interesting, but what I'm hearing from other agents is what's happening is, buyers are going under contract, they're getting into escrow, and then they're finding out that, their rate wasn't locked. And rates have gone up in the last couple of weeks. So they're then canceling escrow because their rate is higher than they anticipated. So can you explain what a lock is and how that works? When do you actually get locked into your rate?
Okay, so once you've got an accepted offer in a house, right? You want to secure your rate. Speak with your loan officer, discuss rates. What are the rates today? So for me, I feel like rates are going to continually rise in 2022. So as soon as you get into escrow, I would lock straight away. So what does that mean? It means that your rate is fixed for a certain period of time. Usually it's like a 30-day, 45-day lock.
And it goes simultaneously with your escrow. So it's something that like your agent should be communicating with your lender to make sure that your lock is good through the life of the escrow.
So if you've got a 45-day escrow, you want to lock for 45 days. And basically that secures your rate till closing.
Got it.
If, say for example, you need to extend, that you can pay a small extension fee and extend for, like, if you need to extend for a week to secure that rate.
I think an important thing with this too is that like maybe sometimes borrowers, maybe they don't realize that like you're not locked until you're actually under contract. So you go, you get pre-approved, and this is a big issue right now. You go, you get pre-approved based off the rate that day. So now you know what you're qualified for, right? So here's your purchasing power. But the problem is as interest rates go up, purchasing power goes down. The amount you can buy is less. So I think a lot of what's happening is people are going under contract based off of that other rate that they were approved for a few weeks ago, a couple months ago. And because pre-approvals are good for what, like 6 months typically, 90 days to 6 months?
Right. But you also, you need to make sure if you're in counters to send all your updated docs to your loan officer, because rates have like rose so much that you may not qualify anymore.
Yeah, and that's what I think is happening a lot, is I think that because rates have gone up, the purchasing power is going down, so you're getting under contract based off your old approval amount, but actually your approval amount has now changed because of the increase in interest rates.
Less borrowing power because we now have to factor in the increase of interest rates, and I'm seeing this like every day. It's like someone who was pre-approved a few months ago now doesn't qualify, or they do qualify, but they qualify for a much less amount.
Even so, it's something, it's more than they want to be spending on their monthly amount, because now the amount of their mortgage has increased.
Exactly.
Yeah.
But back to that, I think as soon as you're in counters, make sure you send all your updated documents to your loan officer. Make sure you're in contact with them, constant communication with them about what steps, like where you are in the home buying process. And as soon as you get into escrow, you need to be speaking to your loan officer, or they should be reaching out to you and to talk about locking, like straight away.
Yeah, good point. Something I get asked a lot is about reserves, and like, what are reserves? How much reserves do I have to have? So can you talk a little bit about that?
Sure. So if it's a conventional loan, so under 970,000, you're going to run it through the automated underwriting system, which is like Fannie Mae and Freddie's their underwriting systems, right? And basically that will give you an indication. They will say, I want to see this many months reserves, which is the reserves is the principal, interest, taxes, and insurance. Like that's what we call 1 month's reserve. So whatever you pay in that 1 month for the loan amount plus the taxes and insurance.
Okay. So it's extra money that should be in your bank account in addition to your down payment.
Absolutely,
So just in case like you lose your job or something happens, they want to make sure that you're not going to default on that loan, that you're still going to have the ability to pay.
Yep. And then with any loan amount, like a jumbo loan, typically it's 12 months.
Okay.
But they all have their own different guides. So it could be less, it could be more, depending on your risk factor as well.
Yeah. Technically, I mean, like that could really like add up pretty quick if you've got, you know, $10,000 a month mortgage. Now you're looking at an extra $120,000 in the bank.
Yeah, absolutely.
But it makes sense because that's a big mortgage payment, and the bank wants to make sure that
it's
they're not going to
for them.
Let's see. Oh, this is actually a really good one. So I see a lot of times, and we talked a little bit about it in the beginning. I've got a lot of clients, especially in the South Bay, who are self-employed. A lot of business owners, entrepreneurs, people who, you know, aren't receiving a W-2, or they don't have traditional tax returns. Maybe they've cash flow through their business, but not through their personal accounts. Are you guys able to work with clients of this type, and, you know, what products do you kind of have for them?
Yeah, absolutely. So typically if someone doesn't have a lot of income on their tax returns, they would opt for something called a bank statement program.
Okay.
So how you qualify someone off a bank statement program is basically just looking at the monthly deposits, how much money is deposited into your business bank account every month, and then there's some form like analysis that is done on the deposits, and that's how we get the monthly income to qualify you for a loan.
Okay.
So all it is 12 months of personal bank statements or 12 months of business bank statements.
Got it. And these are more of like your non-QM type of programs.
Yeah.
Okay, got it. Let's see. Oh, I know what else. Appraisals. So I've talked a little bit about appraisals in my other videos, but what are options, you know, with the market kind of shifting a little bit, prices are coming in higher. I know that I've heard of some appraisals not really coming in at value as of late. So what are the options for a borrower other than on my side where I can negotiate with the seller? In terms of the loan side, what are some options that you guys are able to provide if an appraisal doesn't come in at value?
So if appraisal comes under, there's a lot of things that come into play. But to generalize it, as a lender, we're either going to take the lower, is either going to be the lower appraisal amount or the lower sales price. So what if the appraisal comes in under, we have to take the appraisal.
Sure.
And then depending on what the loan to value ratios are that we can lend up to, then we have to adjust the loan amount based on the appraisal value.
Okay. So you are able to sometimes skew the ratios a little bit, so the client doesn't necessarily have to put more cash down.
Well, if they were going to put, say they were going to already put 30% down, they would have to make up the rest from the sales price.
Yeah.
So yeah, I have seen it a lot been happening lately. The appraisals have been coming, like some of them been coming 300,000 under, which means that the borrower then has to come in with that extra 300,000.
Yeah. So, and again, I don't want to go into too much detail, but types of products, I see all the time, my clients majority of them are using 30-year fixed. But I know that there are a lot of other great loan programs, products out there. So can you talk a little bit about other options compared to, a 30-year fix, and what maybe the benefits are, the cons to it?
Sure, yeah. So there are multiple different loan programs for investors, for owner-occupied properties.
Yep.
But the next common one would be an adjustable rate mortgage.
Okay.
So basically, you have a fixed period of time where you've got an intro rate, which is generally lower than what a fixed rate is at the time. So after that fixed period of time, maybe 5 years, 7 years, it will then revert to a variable rate.
Mm-hmm.
And generally, that rate is then periodically adjusted every year based on the lender's choice of the index. And there are caps, so there's a cap, a periodic cap, and there's also a lifelong cap.
Got it. So it's a good option for someone. I always tell my clients this. It's a really great option if you're going to be moving within the next X number of years, 5 years, 7 years, which most people end up selling or moving within 7 years anyway. So you're going to maybe move within a few years, or you're going to do a refinance, which will change the loan program anyway. And the benefits obviously is your mortgage payment's going to be less. It's usually a lower rate than a 30-year fix or 15-year fix.
Right, exactly.
Okay.
That's why they call it the intro teaser rate.
Intro teaser rate?
Yeah, it's like the teaser to get you to get you to draw you in. But yeah, so you've got if you were going to do an adjustable rate mortgage, I think the most common one would be the 7-1
arm. Yeah. That's intro teaser rate. I haven't heard that before. So it's
maybe it's not even a term. Maybe that's something I just made up. I don't know. It sounded good.
No, you would know more than me, but I'm just trying to connect the dots on it. We're starting to kind of wrap up, but I want to talk a little bit about the market and where we're at. Obviously, we had 2 years of phenomenal rates. Best rates historically we've ever seen. And now, we're kind of shifting back up into what people are calling high rates, but it's really funny when you look at rates historically, we're still
exactly
really competitive, but we all got a little spoiled the last couple of years. But do you have any thoughts or predictions on where you think interest rates? You said earlier you do think it's going to keep rising this year. And I know that some of the Fannie Mae, sometimes they have some predictions on where it's going to go, but I think that's ever changing right now.
Yeah. So, unfortunately, I think that rates are going to continually rise, hike. I think the Fed's going to hike it up a few times this year, several times. They've already done it several times this year. And with inflation, I do think if you haven't refinanced, if it's viable to do so, you should do it now.
Yeah, and that's actually what I was going to ask is if you're seeing refinances decrease with interest rates going up.
Absolutely. I think everyone jumped on the boat last year or the year before when we did have historically low rates.
Yeah.
And so I don't, unless you want to refinance to pull equity out of your home, or you are refinancing because you've been living under a rock for the last 2 years and just haven't got around to it. But
do it now. Do the refis now.
Do it now
because the rates are most likely going to continue to go up.
Yeah, if it's beneficial. And your loan officer will tell you whether there's any point in doing that or not.
Yeah.
Yeah.
I don't think that I have any other questions. Are there any things that you feel we didn't touch on, or any important tips to someone who maybe is a first-time home buyer, or anything important to know that you can think of that we haven't covered?
Honestly, I think just be prepared. Make sure that if you're planning to buy a home in the next kind of year, make sure you pay off any large debts that you have, so you have
more purchasing power. Yeah.
Make sure that you do not keep on opening loads of credit lines and making rash decisions.
Yeah,
About what
no
you're
big
buying.
no big purchases.
Don't go out and buy a Lamborghini.
Yes, please don't,
Yeah.
especially during escrow.
Yeah. Make sure you check in on your credit, see how you're going.
Okay.
Make sure you save as much as you can for closing costs, for a down payment.
Oh, closing costs. We didn't even talk about closing costs. That's a good point.
Yeah.
So there's a lot of money coming out of your pocket or needing to be in the bank at the end of escrow because you need to have your down payment, your closing costs, which I typically quote clients are like around 1% of purchase price. Whatever.
Yeah.
But it's just more cash, you know. It could be $30,000 for closing costs sometimes, I feel like, between escrow and the bank fees and
yeah. I mean, it really depends on how much the house costs, but
yeah,
you make sure that you have enough assets.
Sure.
And the last thing, which is the most important, is don't be going and changing jobs like midway through trying to find a house. If you've already been pre-approved based on your current job, like, make sure you speak to your loan officer before you make any career changes.
Yeah.
Especially if you're a W-2 employee.
Yeah.
I decided to go self-employed because then it's not going to work.
No.
Yeah, speak to your loan officer, but make sure that you don't go and change careers midway through the whole home buying process.
Yeah. Oh, those are my favorite.
Yeah.
All right. Well, I think that's it. I think we can wrap up. So I am so glad that we did this. Thank you for coming and spending some time with me and hopefully providing some type of value and education to the viewers. Now, if someone wants to get in contact with you, what's the best way to do that?
They can go on my website, or they can shoot me an email or call me. I think best to call me, but you can.
What's your email address? We can.
Okay, my email is Katrina.Barry Barry @movement.com.
Katrina, Katrina.
Yes,
some
people don't understand my accent, so
yeah,
I have to spell it.
I just spell my name too. I think that's it. Thank you guys so much for tuning in. And if you have any loan questions, please feel free to leave them in the comments. Otherwise, thank you for checking out the video.